In July, the market soared higher than Carl Fredrickson, which means we investors need to bust out the shovels and dig deep for those discounts. Luckily, I've stumbled upon 3 dividend stocks whose share prices still look attractive despite what the rest of the market is doing, and in this video, we'll be talking all about them and why they might be good pickups for your portfolio in the month of August. And getting right into it, the first one on our list is Crown Castle Inc., who's seen a little bit of a drop in the last month. They're down about 4%, but year to date, they are down quite substantially, down near 22.5%. And if we zoom out once more across these last 365 days, we'll see it's down even more, down 38%, and CCI is currently sitting at its 52-week low. And with the drop in share price, that leaves CCI with a pretty decent P to FFO of about 14, which is still considerably lower than what you'd see from one of its peers like American Tower Corporation, whose P to FFO is sitting up closer to about 20. At any rate, all of this begs the question, why is this stock taking so much of a hit, really across all time periods? But at least in the last month, the stock took a dip after reporting their quarterly earnings on the 19th, where they did beat on both the top and bottom line, but they lowered their AFFO guidance due to lower expected tower activity for the rest of the year. But I will say, otherwise the earnings look pretty solid, and historically this company has been a growth machine. And as far as the performance over the last year goes, I would imagine just that the current interest rate environment we're in is certainly a catalyst for this poor share price performance. But anyway, switching gears and looking at the dividend stats, the forward yield for Crown Castle is really nice, as I'm sure you can imagine with a drop in share price. It's really pushed it up to now near 6%. It's definitely getting up there, and this is also quite a bit above the 4-year average dividend yield, so you're able to get a much nicer cash flow return with this company buying in today than you otherwise would. And taking a look at the rest of the dividend stats, not only do we have a nice high yield here, but the 5-year growth rate is not too shabby either, 8.5, so I would consider Crown Castle double trouble in the dividend department with the high yield and high growth, and the dividend growth history is not too bad either, 8 consecutive years. Overall, if you were looking to invest in a cell tower REIT, I think Crown Castle could be a good option. I know the AMT is the fan favorite in the industry, but Crown Castle does appear to be more attractively valued, and it does have a considerably higher yield than AMT if that's something that's important to you. But with that said, it's also worth noting that AMT has like twice the dividend growth rate of CCI, so pick your poison, I guess. But anyway, moving on to the second stock, this one is Dollar General, who's actually up in the last 30 days. They're not doing so hot otherwise, but in the last month, they are up just about 1%, and year to date, like I said, not too hot, okay? They're down 32.33%, as we can see, and it really fell off a cliff right here, which we'll talk about momentarily. But zooming out once more across the last year, they are down about the same, 32.33%. But anyway, in regards to this little debacle right here, there was a substantial drop-off in June that came after an earnings miss, where they underdelivered on both revenue and earnings, even though in this quarter, revenue was still up year over year. Aside from that, though, I think this company looks to be firing on all cylinders with really strong growth all across the board, from revenue all the way down to free cash flow. Not to mention they've been buying back shares pretty aggressively and growing the dividend at a similar pace. And on that note, taking a look at the dividend stats, starting here with the forward yield, this admittedly is not the highest, only 1.4%, but Dollar General is a high growth dividend stock, as we'll see in just a moment. Also, it's worth noting that the yield is typically lower. I mean, the 5-year average yield is less than 1%, 0.89%, as we can see there. So the forward yield right now is sitting nearly 60% above the average. I think that's great. And taking a look at the rest of the dividend stats, like I said, this is a high growth dividend stock with a really nice 5-year dividend growth CAGR of 15.7%. And the payout ratio is really low too, just about 20%. So the dividend's pretty safe. It's really not a huge burden on the company financially. And the dividend growth rate's not bad either. They've been growing it for the last 5 straight years. Anyway, moving on to the third stock of the day. This one is going to be Pfizer. And I know there's some mixed feelings out there about Pfizer, guys. I get it. But at the same time, I don't think there's any denying that it's at a pretty attractive valuation right now. I mean, in the last month, they are down 4%. So in the last 30 days, they've seen a little bit of a drop there, and then year to date, they are down quite a bit, down 27%. And then in the last year, they're down about the same, just under 27%. And they're kind of tickling their 52-week low there. They're really not too far off from it, definitely within 10%. And like I said, the valuation overall is looking pretty sweet. Over here on the valuation page, just starting here with the PE ratio, it's really not too bad, 11.3, okay? And this is just a hair below the 5-year average PE ratio. So there's a little bit of a relative discount there. And if we scroll down, taking a look at some other metrics, looking at the forward price to book, 2.11, really not too bad. And this is 35.5% below the company's 5-year average price to book. And the price to cash flow is great too, 11.46, which is 15% below the company's 5-year average. But anyway, back over here, taking a look at the share price performance, once again, it begs the question, why is this stock going down? And what we're seeing here is essentially a return to normal. I mean, as you can see over the last couple of years, their revenues, earnings, and free cash flow essentially doubled from the COVID vaccine sales, and the share price price headed in a similar direction, peaking at around $60 per share at the end of 2021. And now that COVID's pretty much behind us, it's not as big of a thing anymore. The company's revenue and everything below it has been returning to homeostasis, as we can see from this graph here, and this is why the share price has been coming back down. But still, just in terms of profitability, I mean, Pfizer is a very well-oiled machine. Their gross profit margin is extremely high, about 69%. Their net income margin is fantastic, 31.25%, and the levered free cash flow margin is also really sweet, sitting just under 20%. So I think Pfizer is essentially like printing cash flow, which bodes well for the dividend and is obviously good for shareholders. And getting into the dividend stats, they have a really high forward yield of 4.4%, which is about 20% above the company's 5-year average yield. So definitely a nice cash flow return from these guys. And looking at the rest of the dividend stats, you're also getting some pretty steady, not very aggressive, but steady dividend growth with a 5-year CAGR of 5.3% and a very low payout ratio. So just like we saw with Dollar General, this dividend is not stressing the company out at all. And with that, guys, those were the 3 stocks that I really wanted to hone in on today, but still, there are quite a bit more out there that I think you need to keep your eye on. The first one to look out for is Verizon, and you guys know there's some stuff going on in the telecom industry right now, so it's definitely bringing Verizon's share price down. They're down 5.5% in the last month, and then year to date, they are seeing quite a decent drop, 15.5%, so keep your eye on this one. And you guys already know, we can't mention Verizon without also mentioning its counterpart, AT&T, who's also down about 5% in the last 30 days for pretty much the same reason, and then year to date, they are down a bit more actually. They're down 21.25%. Anyway, moving on to the third one, guys, I've tried to be good, okay? I've tried not to mention this one all the time and really shove it down your throats, but I think KRC is one that you need to keep an eye on, okay? In the last month, they've had a really nice rebound. They're up 13% just in the last 30 days, so pretty nice comeback. I'm happy with that. But year to date, they are still down a decent amount. They're still down about 12%, but like I said, they're rebounding. They are making their way back up. And then jumping over to another real estate investment trust, WP Carey, guys. Keep your eye on this one. They are up quite a decent amount in the last month, about 5%. And then year to date, they are still down actually. They're still down 8%. So definitely one to watch out for. And after WP Carey, we've got Williams-Sonoma, which is the most recent addition to my portfolio. In the last month, they are up nearly 6%. So they've had a pretty good July, I'd say. And then year to date, they are also up as well, up 13%. But I still think the valuation's looking pretty attractive. So I do think it is one to keep your eye on. Anyway, next up is UGI, who's been pretty beaten down lately. I mean, in the last month, they're only down 2%, but looking at their year-to-date performance, guys, they are down 30%. 30%, so, you know, looks to be a pretty cheap one right now. Anyway, this next one is going to be CVS, guys, who's had a nice little rebound in the last 30 days. They're up 8%, but year to date, they are still down about 20%, so, you know, a potentially discounted one right here. Anyway, moving on, the next one is Humana, and we talked about this one in last month's video, but in the last 30 days, from then until now, they are up about 2%, but year to date, they are still down nearly 9%, and then in the last year, they're still down as well, down about 6%. And then you got to keep your eye on Hormel Foods, guys. In the last month, they're down about 1%, so a little bit of a drop there, but year to date, they are down 12.25%, and they are starting to tickle their 52-week low. It looks like they're, you know, well within 10% of touching it, actually. Now, those were all of the stocks that I think you need to watch out for and keep an eye on, but next up, I've got 5 more that are the complete opposite of that and are ones that you should never buy again. All 5 of these stocks are ones that I would consider to be yield traps, and they are ones that you should avoid at all costs. So click right over here to find out why, and I'll see you in the next one.